Most people who sell covered calls pick strikes above their stop price and pray it doesn't get called away. I do the exact opposite. I sell calls that are already in the money. And last year, that one decision made me over $15,000 in pure time value income. Hey, I'm Jaden, and this is where we break down what really moved the market, the way nobody else will. None of this is financial advice. It is the story behind the numbers. Here is what the internet tells you. You own 100 shares of Apple at $2.30. You sell a $2.40 call, collect maybe $3 in premium, and hope the stock stays below $2.40. If it does, great, you keep $300. If it rips to $2.50, your shares get called away at $2.40, and you miss $10 of upside. This is what most covered call tutorials teach, and it works. Until it doesn't. Now here's what I actually do. Same 100 shares of Apple at $2.30. But instead of selling the $2.40 call, I sell the $2.20 call. That is $10 in the money. The premium, $13.50. $10 of that is intrinsic value. The market just giving me back the gap between strike and stop price. But the other $3.50, that is pure time value. That $3.50 is my paycheck. Here's the thing people miss, that intrinsic value, the $10. I don't care about it. It cancels out when I roll. The only thing that matters is the time value, because that is the part that decays to zero every single month. And every month when it decays, I get to sell a fresh batch. It is like collecting rent. The intrinsic is the house. It doesn't change. The time value is the rent check. Let me show you 4 months of this on Apple. Month 1, stock at $2.32. Sell the $2.20 call for $13.50. At expiration, buy it back for $10.20. Nearly pure intrinsic. Net credit $3.30. Month 2, same strike, stock at $2.28. Sell for $13.10. Buy back at $10. Net credit $3.10. Month 3, stock bumps to $2.35. Sell for $13.95. Buy back at $10.50. Net credit $3.45. Month 4, 2, 30. Sell for $13.50. Buy back at $10.30. Net credit $3.20. Total income across 4 rolls, $13.05 on a $23,000 position. Now let's compare. Over those same 4 months, an OTM strategy at the $2.40 strike would have collected maybe $1,000 total, if you were lucky and the stock stayed below $2.40 every single month. But Apple touched $2.37 in month 3, an OTM seller would have been sweating. I wasn't, because my strike was $20 below the stock. I had a built-in cushion, more premium, more protection, more predictable. I know what you're thinking. If the call is in the money, won't you get assigned? Won't they take your shares? Here is the secret that options textbooks bury in a footnote. Early assignment almost never happens. Why? Because the person who bought your call would be throwing away money. If they exercise early, they destroy the remaining time value. A rational trader sells the option instead. The only real exception is dividends, and you can plan around that. The reason I roll to 30 days, to expiration every time, is this curve right here. Theta, the rate at which time value decays, accelerates as expiration approaches. Between 60 and 30 DTE, decay is steady. Between 30 and 0, it falls off a cliff. I want to sell at the top of that cliff and let gravity do the work. By rolling at expiration into a fresh 30-day cycle, I'm always harvesting the steepest part of the curve. I'm not going to lie to you. This isn't a free money machine. If Apple goes on a face-ripping rally from $2.30 to $2.70 in a month, I'm capped at $2.20. I missed that whole move. And if it crashes below $2.20, I'm still holding shares that are losing value. The premium cushions the fall, but it doesn't stop it. This strategy prints in sideways and slightly bullish markets. In a melt-up or a crash, you feel it. Right now, I'm running this across Apple, Amazon, NVDA, and Exxon. Different sectors, different volatilities, but the same mechanic. Sell the ITM call, harvest the time value, roll at expiration. Higher IV stocks like NVIDIA give me fatter premiums. Lower IV stocks like Exxon are steadier. The portfolio effect smooths everything out. It is not exciting. It is not going to make you rich overnight, but it compounds. The hardest part of this strategy isn't the mechanics. It is the mindset. You have to stop thinking about whether the stock will go up or down and start thinking about whether it will stay within a range. You're not a stock picker anymore. You're a time value farmer. And the harvest comes every single month. That is the real story now. You know how it actually worked. I'm Jaden. Thanks for watching.